All right. And just like that, it's 12 o'clock. So good afternoon, I guess it is exactly. Good afternoon, everyone. Again, to those of you who I already greeted. Um, Thank you for being here for the Genus 2023 year in review and 2024 forecast. For those of you who have just joined us, my name is Shannon Ward, and I'm Chief Growth Officer and Partner here at Genus Capital. And to those of you who are in the room, thank you so much for making the time to be here today. It's so nice to see everyone in person. And for those of you who are on the live stream, thank you for being here via technology. We have people from all across Canada who are joining us that way today. So really glad to have you here as well. So I will be your host for today's session. I also have in the room with us today some of my colleagues who I would like to introduce. Wayne Washell is actually not in the room, so he will be joining us remotely later on in the session, but he will be here. So Wayne is our executive chairperson and our co-chief investment officer. Actually in the room with us is Mike Thiessen, our chief sustainability officer and our co-chief investment officer. We have Justin Hahn, our macro analyst. And we're also happy to have Sebastian Rheaume, who is the managing partner of Alpha Fix. And Alpha Fix is our fixed income sub-advisor. So he'll be here to talk about that aspect. So we've had a really exciting year here at Genus since we last met together. And one of the things that we're particularly excited about is to announce that we have launched a Toronto office. So we're very pleased to have brought on Daryl Brown, who's our head of Eastern Canada, to head up that office and to help us service Eastern Canada a bit more thoroughly. So we're very excited about that development. Additionally, we have the rest of our portfolio manager and client relationship manager team here today. So I want to just take a second to make sure that you are putting faces to names and that you can know who's on our team, because we've actually had some changes in that team as well. So we have Tiffany Lusher. Where are you, Tiffany? Tiffany Lusher. So she is another exciting addition to our team this year. Tiffany brings over 18 years experience as a portfolio manager, and we're very excited to have her as part of the team. So welcome, Tiffany. Secondly is Evelyn Wu. Evelyn, where are you? Oh, you're in the back there. So Evelyn recently completed her client relationship manager designation, and she's moved over to this team from our client service team. So we're very excited for her future with Genus. So thanks, Evelyn. We also have Grant Conroy, Thomas Irwin. Great, thanks, Thomas. Ian Lusher, Sue Talbot up at the front here. Kenneth Sin, I believe he's in the back. Yeah, there's Kenneth. Stephanie Chu, who's our head of foundations and nonprofits. And last but not least, Mary Lou Miles, who's our head of wealth management. And Mary Lou will actually be joining us for the question and answer period later. So she'll be joining the panel a little bit later in the session. So just as a reminder for questions that you can submit those, let me get back to the right slide, that you can submit those a couple of ways. You can go to slido.com and then put in the event code GCM 2024, and that will get you to the right place to submit questions online. You can also just use that QR code to go directly there if you'd like to on your smartphone. For those in the room as well, if you prefer, we can do it, like I said, the old-fashioned way, and we'll have a mic that will go around the room during that part of the session as well. I'd also like to take this opportunity to highlight some members of our client service team. They're such an integral part of what we do at Genus. One of our core values is fostering client success, and we definitely could not do that without them. So just wanted to introduce you to Batul Tajani. She's our head of client services. She's in the back there. Carol Ngay, Joy Dong. Great, and Amy Coots. Thanks, Amy. And Amy's actually supporting all of you on the live stream as well today. So if you have any issues, she's the one who's helping you out there. So thank you, Amy. And of course, last but not least, our CEO, Steve Au, is also in the room there at the back. So thanks for being here, Steve. So in today's presentation, we're going to explore some of the key events of 2023 and try to provide some insights into some of the upcoming trends for 2024 and what you can expect for your portfolio. So first, before we get into the topics deeply, I want to take care of a couple of housekeeping items. As I mentioned, if you have technical trouble on the live stream, please input the issue into the chat and we will get someone to reach out to you and help you out. Also, a recording of today's session will be made available to all of you who are in person as well as on the live stream. It will be emailed to you. In addition, we'll have a copy of it on our website. So if you'd like to share it with family or friends or revisit any of the content, you can also do that there. Before we really get started, I want to start by extending my gratitude to the Indigenous peoples, specifically the Coast Salish, Tsleil-Waututh, Musqueam, and Squamish nations, whose land we're honored to gather on today. At Genus, we're committed to continually reaffirming our responsibility in improving relationships between nations and our own understanding of local Indigenous cultures and peoples. I was personally grateful this past Truth and Reconciliation Day to spend the day with some members of the Klahoose Nation on Cortes Island. And we were lucky enough to hear from Karen Joseph about her work with Reconciliation Canada. And on that day, I learned a new term that I want to share with you today. The term is Namwayut, and it means we are all one. We are all one common humanity, and we're one connected whole. And so I hope that you can carry that concept with you the way that I have since I learned it. So let's get started with the presentation. We're gonna start with Mike Thiessen, our Co-Chief Investment Officer and Chief Sustainability Officer. Thanks, Mike.
Great, thank you, Shannon. So I'm excited to be here today. Good to see so many people here in person. Good to see people, well, good to have people online, can't see you, but great to have everyone here today. So I'm gonna be talking about innovating to meet client values. And so I'm gonna go over aligning your portfolio with your values. I'm going to be talking about one of the innovations that we had about 10 years ago that is meeting a lot of demand right now. That's our high impact equity fund. And then I'm going to be talking about new innovations, both in 2023 and upcoming ones in 2024. So first off, aligning portfolio with client values. So we have been working with you, our clients, for the past 35 years. And we've really grown to know that everybody has different priorities, everybody has different needs, everybody has different values. And so we want to meet you where you are with these needs and these values. So that's why we have a series of different funds. So we have our responsible funds, we have our fossil-free funds, and then we also have our impact funds. So our responsible funds have the core goal of risk-adjusted returns. So here we're using our macro models, we're using our stock selection models to maximize risk-adjusted returns in any way we can. We do have some ESG integration within these funds. So ESG stands for environmental, social, and governance. And ESG integration is when you put some of these factors into your financial models. So we only do ESG integration for these responsible funds if it is adding to performance, or we believe it will add to performance. So we do have factors such as labor management within our financial models. So that's a social factor. But if you look at back tests that we've done, companies that have high labor management scores tend to outperform companies with low labor management scores. And we believe that this will continue into the future as well. So there's some ESG integration if we believe that it will add to performance. And then we have our suite of fossil-free funds. So with our fossil-free funds, we have a lot of value-added screens. Or values-based screens, I mean. So with these screens, we're cutting out different areas that don't align with people's values that are investing in these funds. So we're not investing in things like fossil fuels or gambling or tobacco. We're not investing in other controversial industries or companies that have widespread controversies. Maybe it's around the environment, or it could be around the communities that they're working in. We also look at things like carbon intensity. We look at misalignment with certain areas that our clients value that are in these funds, such as gender equality. And then we have our high impact funds. So this is a series of funds that not only has values-based screens, but here we're trying to only invest in companies that are making a big difference in the world. So here we're investing in companies that are in energy efficiency or renewable energy or healthcare, education, maybe it's green real estate, different areas that are making a big difference and are linked to a United Nations Sustainable Development Goal. And this is an area that we've had a lot of interest in the past couple of years. And one of these funds within kind of our impact category is our high impact equity fund. So this fund has had a lot of demand this last year. And there are a couple reasons for that. One of the reasons is a values-based reason. So a lot of people are learning more about impact investing. Impact investing is where you are striving to make a difference and meet financial goals at the same time. So a lot of people didn't know until the last few years that this was a possible way to invest. And it does align with certain people's values, a lot of individuals, a lot of foundations. We're getting a lot of interest from larger institutions as well for this fund. So this high impact equity fund has been around for 10 years now. So it has the longest track record out of any impact fund that's fully fossil free in Canada. And so people are wanting it for these value reasons and then also for performance-based reasons. So its performance has been good since inception, but exceptional in the last 5 years. So in the last 5 years, performance has been 13.8% on an annualized basis versus the market that's been 12.6%. So it has all of this impact, and at the same time, it's beating the market by 1.2% on an annualized basis. And it's also doing all of this with lower market risk. So it has lower market risk than the benchmark, lower market risk than most of the other ESG funds out there. If you look at peer comparisons, we're in the bottom quartile for market risk, and that's where you want to be. You want to be in the bottom for risk. And then when we compare with other funds in North America, these ESG funds, we're actually in the top quartile when it comes to performance. We're actually in the top of the top quartile for performance. So high performance, low risk, and a lot of impact. So it's gaining a lot of interest and a lot of demand from various institutions. So to give a little bit more color on what's actually in this impact fund, we wanted to highlight one of the investments. So this is Dexcom. You may have heard Dexcom before. They're an innovator when it comes to glucose monitors for diabetics. They have small product that you can typically attach to your arm, and then you can test out your real-time blood glucose with an app. Doctors have access to this data too. And so they can look at different trends with your blood glucose. And studies show that it lowers the chance of hypoglycemia and other issues with diabetes. And so the net impact score for this investment is 100%. The net impact score is an impact measurement tool that we created a few years ago that measures the percentage of revenue that a company is generating from a product or service that is highly impactful and linked to a sustainable development goal. And so in the instance of Dexcom, 100% of its income, or 100% of its revenue is coming from high impact areas. And it has an ESG rating of A. And then we also wanted to talk about another one of our impact funds. So this is our Global Impact Bond Fund. It's a green bond fund. It's managed by AlphaFix. So AlphaFix is our sub-advisor. They manage, for fixed income, they manage all of our fixed income funds. So whether you're in responsible funds, fossil free, or impact, AlphaFix is sub-advising on the fixed income. And we're lucky to have Sebastian here today to talk more about fixed income. And so within the Global Impact Bond Fund, one of the green bonds is TransLink. And so green bonds are issued by corporations or governments, and the proceeds have to go towards green projects, such as low carbon transportation, green real estate, could be renewable energy. And so in this case, the proceeds are going towards the Surrey-Langley SkyTrain. So this will greatly reduce the carbon footprint of travelers in that area and also contribute towards the decarbonization targets of TransLink. There we go. So we have the array of funds that we talked about before. So we have the responsible funds, fossil-free funds, and then we also have impact funds. And so portfolio managers are able to really customize your portfolio based on your needs with these funds. But there are some clients that want to go even above that customization when it comes to their portfolio. And so we can actually create extremely customized portfolios with about 5,000 different ESG factors. So maybe there's a certain area that you're really passionate about that maybe isn't in one of our funds, and we can customize that for you. There is a $2 million minimum for those extremely customized portfolios, but if that's something that you're interested in, definitely reach out to a portfolio manager. So I want to talk about some innovation. So I want to talk about some innovation from 2023 and then what we're thinking about for 2024. So this last year, one of the big innovations that we had was the first Indigenous conflict screen for a public equity asset manager in Canada. So we've heard from clients for a long time that they have wanted to screen out companies that have severe conflicts with Indigenous communities. We have been wanting to do this, but the data hasn't been available. Finally, there's good, reliable data out there, so we were able to create this screen for our clients that they can't get anywhere else. And so this screen excludes companies that have severe conflicts with Indigenous communities around the world. So an example of this would be Rio Tinto. So Rio Tinto has an iron mine in Australia, and in 2020, they destroyed an Indigenous cultural site within Australia. And so this obviously set off flags and controversies. And so a company like Rio Tinto wouldn't actually make it into the portfolio right now because of this widespread controversy. Another area of innovation in terms of values-based screening is our biodiversity screen. So this screen is only applied to the fossil-free funds and the impact funds. Same with the Indigenous screen, only the fossil-free funds and impact funds. Biodiversity has been a big trend in sustainable finance right now. A lot of people that are wanting to take climate action with their capital are realizing that it's not just all about carbon emissions and carbon intensity. We have to account for the whole ecosystem. So we've developed a biodiversity screen. So here we're reducing the exposure to companies that have a negative impact on biodiversity. So we basically have a scoring system, and companies have to be beyond a certain threshold in order to get into the portfolio. So an example of a company that would be screened out based on this screen would be Bath & Body Works. So Bath & Body Works procures its palm oil from deforested Amazon forests in Brazil. They also don't have a sustainable supply chain policy. So because of this, they actually rank quite low with the biodiversity scores. And so they wouldn't actually meet the threshold to make it into the portfolio. And then what's new for 2024? So we're always innovating. Genus has really been built on innovation. When it comes to our financial models, we're always innovating, always working on improving these models. When it comes to our macro models, Justin and team are always working to improve. When it comes to our stock selection models, Lisa and team are always working to improve those. This year, we're really everyone on the investment team is really upgrading our skills when it comes to artificial intelligence. We have some artificial intelligence integrated into our model building, but we want to do more of that. So we're working hard at that. And then when it comes to values-based innovation, this year we're going to be focusing on climate value at risk. So this is a risk measure looking at potentially what percentage of a company's value could be at risk based on changes in climate and other things that are associated with that. So physical risks such as flooding or wildfires, and then transition risks. So how much of their value is affected by regulatory changes or tax changes or even economic trends. And then we're also looking at Scope 3 emissions. This has been something that we've looked at for years, but the data hasn't been very reliable. The data is getting better. So Scope 3 emissions are the indirect emissions that a company has. So right now we already look at Scope 1 and 2. Those are the direct emissions. So those are things like energy usage. Those are things like the emissions that you have from your operations. But Scope 3 is indirect. So Scope 3 focuses on the supply chain, so how the products are actually made, and then also looks at the use of those products. So that's something that we're going to be looking more into this next year. So we're always striving to align portfolios with your needs and priorities and values. And we're excited to see that some of our innovations are really paying off for clients, and there's a lot of demand for them, such as our high impact equity fund. And we're going to continue to innovate in 2024, both in our financial models and our values-based integration. So next up, we have Justin Han, and he's going to be talking about what happened in the economy last year in 2023.
Great, thanks, Mike. As Mike mentioned, my name is Justin Han. I'm the macro strategist here at Genus, and I'll be going over what we saw in the economy last year and what we expect going forward. So to begin, I'll start with how we got to the high inflation that we see today, as well as why we don't think it's going to be similar as we saw in the 70s. Next, I'll go through the central bank pivot and how that narrative turns into the soft landing narrative that we've been seeing lately, but also go over some of the hard landing ideas and charts. Finally, I'll close with the one thing that we'll be watching, which is the government debt levels. So how did we get here? So from these two charts, you can see the chart on the left here. Inflation happened because of excessive money spending as well as excessive government spending. So the chart on the left shows that money printing here was way above trend. Although it was needed during the pandemic, we can see that it might have gone a bit too far, but has been trending downwards. On the other side, the fiscal side has continued to spend. Despite money printing slowing down, we saw during last year there was a lot of social program spending as well as war spending, so those government debt levels have continued to increase despite the slowing in money supply. So that's something that we'll be watching, and I'll get to a bit later on in my presentation. So all this led to what we saw during 2022, where inflation levels hit the highest levels that we've seen since the 1980s. So from this chart, you probably felt this on your everyday life in terms of groceries, large ticket item purchases, as well as travel. We saw airline prices soar during last summer if you tried to travel during that time. So as a result of all this, the central banks had to increase rates significantly higher, as well as stop their money printing. So this chart is pretty simple. So the purple line here shows that pandemic money printing during 18 months ago has led to inflation during last year and this year. So the three lines here are pretty positively correlated with each other. So the green line here is the PCE index that the Federal Reserve looks at when determining whether to raise or hold rates where it is. It's also correlated with the consumer price index as well as the producer price index. The good news is that the policies of increasing interest rates as well as lowering money printing has seemed to have worked, as it's following in trend, and we expect to see lower rates going into this year as well. So if we look back at history as well, there is a time period where we see that interest rates did follow a very similar path. We can see from this chart here, the top chart here, during the 1970s, we've got a similar path of inflation. So during the 70s, there was a lot of government spending, as we see today, on social programs as well as war spending during that time as well. In addition, we also saw increased oil prices due to the Arab oil embargo, which all led to increased levels of inflation. So why don't we expect this to happen this time around? That's because the Fed action during that time was quite different from what we're seeing today. So the US Federal Reserve was actually increasing rates while inflation was peaking during that time. And they started lowering rates as well, way earlier at any sign of a downturn in inflation. And that's why we got the reignition of inflation. This time around, the red line here, we can see that the US Federal Reserve really increased rates significantly faster and sharper and have held those interest rates at these levels despite inflation still trending downwards. And they're also continuing to hold, as of this Bank of Canada yesterday, continuing to hold the rates at these levels. So despite the Federal Reserve not pivoting on their policy yet, they are signaling to the markets that interest rates have peaked. This is because the blue bar here, we can see that the Federal Reserve projections on what interest rates will be going forward, and the orange line is what the markets are expecting. So during 2024, we see that markets and the Federal Reserve are expecting about a 1% decrease in interest rates. In 2025, there's a bit of a difference where the markets are pricing in a bit more aggressive of a rate cut, down to about 3.5%. So that's on average about a 1% lower rate for the next 2 years, with the longer term average being about 2.5%. That's something we don't expect going forward. Interest rates come back down to zero like we saw during the last 10 years. So we're also seeing some positive about this information in our data as well. So the housing market, after being negative for home sales on a year-over-year growth basis, has finally come back to positive. So this is a good sign for the housing market, and they're also believing that interest rates have peaked. And also with the 5-year bond yields in the US and Canada, they peaked at about 5 and 4.5% and have come down about a 1%. So that reinforces the idea that the market is believing what the Fed is saying, and that interest rates are going to come down in the next couple of years. This also fits into our soft landing narrative, with the housing sector being such a big part, and having confidence in that market is a very positive for soft landing scenarios. In addition, the labor markets still remain resilient despite the slowdown in the economy that we've been getting. So unemployment rates in Canada and the US still remain at about historical lows, but in Canada, they are slightly higher than what we were seeing previously. So the lows that we saw were about 5%, and now they've gone up to about 5.8%. So we might see some policy divergence between Canada and US going forward because of that. But it's also important to note that the job data as well as unemployment data is a lagging indicator. So despite it being a positive right now, things by the time we see the numbers change in in the unemployment data, a recession is generally already underway, and it's a bit too late to catch anything. So, but in spite of that, a positive labor market in the face of slower economic growth is a good thing and positive for a soft landing. Next, I'll go over some negatives here. So despite the strong labor data and the unemployment rates, as well as wages growing on a year-over-year basis, we have seen that the real wages, when adjusted for inflation, have not kept up with the trend pre-pandemic. So this is what the daily consumer is feeling and why everything feels a bit more expensive. It's because wages are a bit stickier than normal, are a bit stickier and have failed to keep up with the rate of inflation. So who has benefited from this? It's usually the corporations. We've seen companies post all-time highs in the markets, as well as record profits and lowering costs. So those are the big benefactors of this. In addition, previously I showed that money supply is a good predictor in terms of where inflation is going to go going forward, but it's also a good predictor, and there is a strong correlation, a positive correlation with economic activity. So the blue line here represents the Global Manufacturing Purchaser Manager Index, which is just a survey index. So any reading above 50 means expansionary, and any reading below 50 means that you're in contractionary territory. So from the orange line and the blue line here, we can see that the two lines are fairly correlated, and it's pointing towards even more weakness in the economy going forward. So going back to where I began, and something that we are keeping an eye on, are government debt levels. So I mentioned that government debt levels have been going up, but from this chart showing the government debt to GDP, it is going downwards for the last couple of years. That's mainly because the higher inflation has helped boost up those nominal GDP numbers. So despite the US government continuing to spend on fiscal policies, we have seen these levels go downwards. We can see in Canada in particular is just as bad as it was during the 90s. So during the 90s, the Canadian government had excess deficits and a higher interest cost because of that, with interest rates almost double what they are today. So this is something that we'll be watching going forward as the new governments in the US this year, as well as the Canadian elections next year. This will be a big problem of focus potentially going forward. So to summarize, we believe that inflation has peaked, and due to the central bank action this time around, we don't expect it to reignite just like we saw in the 70s. There are positive signs in the economy as well as the markets showing that they believe that the Fed has pivoted and is signaling lower rates going forward. Thirdly, we believe that the consensus here is a soft landing due to the strong labor market resilience that we're getting, as well as the positives we're seeing in the housing sector. But we are still watching the indicators to see a potential for a hard landing. And lastly, government debt levels will be a concern, as debt servicing costs going forward will be quite an issue for governments if interest rates continue to be this high, as well as governments continue to spend. Next, I'll pass it off to Sebastian to talk about our bond portfolio.
Thank you, Justin, Mike, and Wayne, and the rest of the Genus gang for inviting us and letting us present today. It's always a pleasure. My name is Sébastien Réaume, co-founder of Alpha Fixed Capital, sub-advisor for the fixed income portfolio of strategies. Again, very, very nice to be here. I'm going to take 5 to 6 minutes to go over what we saw in 2023 and give you an idea of what we're going to see in 2024. Just maybe before I get into that, for us, we're end of cycle. End of cycle tends to be always a bit more difficult to have some very strong convictions, as a case to make on both sides. So not as strong convictions as we're used to seeing, but certainly more than happy to share our views with you. So I'm going to take basically what Justin explained in terms of macro environment, what happened into 2023, and go over what that translated in terms of performance for fixed income in 2023. Justin already alluded to the fact that the key risk we want to highlight for 2024 is a potential monetary divergence between Canada and US, and the consequence it might have in terms of reducing the ability of the Bank of Canada to reduce rates. And also, we continue to bring forward impact investment through the green bonds that we buy in the portfolios. Just a really quick note of who are we at Alpha Fix. So we are one of the few remaining independently owned money managers. We basically just do fixed income. That's our bread and butter. So we have a very narrow focus. When you have a very narrow focus like that, you tend to innovate quite a bit. Highlighted some of the innovations that we've had since we started. And at the end of December, we had 14 billion of assets under management, all fixed income institutional clients in Canada. So again, taking what Justin explained in terms of macro environment and what does that translate into. So there's two lines here. The green line is the 10-year rates, and the black line is actually the spread. So I'll start with the green line. So we had a 2023 years that was composed of two periods. First, we had rising rates, and I'll forget about the little bleep there from the regional bank crisis in early March. But we had rising rates, which was a reflection of higher inflation and a higher willingness of central banks to raise rates. And then rates went up until end of September, beginning of October, where the Fed kind of said, okay, maybe we've done enough, and that famous pivot. And then you could see the second or the last quarter of the year, rates come down significantly. So overall, rates actually ended up a bit lower than where they started. So the 10-year yield is actually 20 basis points lower. So that's good news for the overall asset class. And then when you look at the spreads, which is a black line, the opposite, right? So we had a really good year for spreads. So spreads kind of converged throughout the year and actually performed quite well. And spreads are about 30 basis points tighter. So overall, 2023, when you look at the annual results, was actually really positive for fixed income. It was a different story if we were talking at the end of September. But so here, the third column from the left, you can see the performance of the different bonds, funds that we manage for you. So anywhere between 6 to almost 9% return. Like I said, lower rates, compression spreads, very good for fixed income. So the good news is that overall positive results for the different mandates, and also we were able to extract positive value add also in most of the accounts. So overall, I think these are really interesting returns, fixed income. Keep in mind we had negative 2021 returns, negative 2022 returns, so finally we're back to positive returns in 2023. So that was good news, I guess, overall. So what do we see in 2024, and where are the risks? So I just want to spend a little bit of time on the key driver for us on the economy is the consumer. And the issue we have, so the green line is the debt ratio, so the leverage in the US, and the black line is in Canada. So I'll start with Canada. Canada is one of the few countries that has not deleveraged post-2007, 2008 crisis. So you can see the black line continues to rise. Not the end of the world, right? So we've had high leverage for a long time, and we could kind of learn to deal with that. I'll make the contrast right now with the US. You can see the US has deleveraged significantly since the financial crisis of 07, 08. And now you can see the big gap between those two measures. And that's an important reality that we might face into 2024. So Canadians are very indebted. Like I said, not the end of the world unless rates start to go higher, which is exactly what has been happening in the last few years. And the issue with the Canadian economy is that when you look at our mortgage markets, anybody goes for a mortgage here, you go to your financial institution, the maximum term you get is 5 years, which basically means within the next 5 years, all the mortgages in Canada will have reset at higher rates. So we started raising rates in February of 2022, which means by February 2027, all the mortgages will have reset at higher rates. That's a very fast mechanism of transmission for the monetary policy. So the Bank of Canada raises rates, and that incremental rates, makes its way through the economy really fast. At the end of December 2023, we had almost half of the mortgages that had already reset very fast. And you can see that in the next 3 years, basically the balance is going to be resetting at higher rates. So the consumer has a really tough environment to face over the next 3 years. And what's really concerning is when you put this together, so high leverage and fairly faster, higher rates in the Canadian economy, you have a debt service ratio, again, the black line in Canada, the green line in the US, which is fairly high. So 15.2% of disposable income right now is going to pay to service debt in Canada. That's a historical high in Canada. And we only know that number will keep on going because we know that the next 3 years, rates are going to go higher. So that number will keep on going higher. So that's not really good for the consumer. 15.2%, how do we compare it to the rest of the world? Well, we're not the worst, but we're the third worst. So it's a really negative number. It's not good for the economy. Contrast that to the US. So the US delevered. They have a much slower transmission mechanism for higher rates because they have 30-year mortgages in the US, so they're very well protected. So you can see that the debt service coverage in the US is actually closer to 10%, which is a historical low if you make a abstraction during the pandemic period. So a very fundamentally different environment for the consumer in the US versus Canada. And now what's really surprising to us is that when we take that weakness in the consumer in Canada and we look at what the evolution of the GDP has done, you could that's a black line. GDP has slowed down, but it's still positive, right? And we would actually expect GDP to be somewhat negative, given that the consumer is facing huge headwinds. And what's hidden in these numbers is that we have an immigration policy that is very generous, right? So we have a lot of people coming into Canada. And that really comes and obscures a bit the reality. So when you actually take the GDP and you renormalize it and bring by GDP by capita, which is the green line, then you could definitely see a weakness in Canada. So, and we've never seen a decrease in GDP per capita of this magnitude without being in a recession. So our view of Canada is that we probably are in a recession right now, and if we're not, we're probably going to be in a recession in a short time just because of that huge headwind that we have on the consumer side. And then when we could look at the U.S., different story. As I said, the consumer is in a much better position. Justin also alluded that the government right now is stimulating the economy as if we were in a recession, and we're not nowhere close to being in a recession in the U.S. And when you look at some of the most cyclical sectors in the U.S., we're not seeing any weaknesses right now. So we do think Canada is going to face, a tough time in 2024. And we kind of agree that U.S. is a different story. If we were to pin a number in terms of probability of the recession in the U.S., we'd say 50-50. Usually when a money manager tells you it's 50-50, it's because he has really no idea which side it's going to go. And it's the case really in the U.S. I think there's a strong case to say that we will see that soft landing. And that's the danger. So if we have Canada slowing down and U.S. doing well, that reduces the ability of the Bank of Canada to decrease rates, because there's a reality that if the Bank of Canada has a significantly lower overnight rate versus the U.S., then the Canadian dollar is going to start to weaken a lot. So it's not assured that we're going to be there. I mean, it might sound a bit counterintuitive, but the best case for Canada would be actually a recession in the U.S. That means that we could all have lower rates, give a bit of oxygen to the economy. That's it. Glad to entertain any questions if there are any. Thank you very much.
Thanks so much, Sebastian. So now we will go to Wayne Wachel, who is coming into us remotely today. So welcome, Wayne.
Thank you. Thanks, Shannon. I'm Wayne Wachel, Executive Chair and Co-CIO at Genus. And let's start off by going to the next chart, please. Well, the Fed has pivoted, and that always means the market gets optimistic. And it's usually positive for stocks and for bonds. In addition to that, this year we have an election year, and that usually means the Fed's going to probably err on the side of being too easy versus too tight, which usually makes it positive for equities. You go back through time. As well, looking at our models, they have pivoted to more positive as well, more risk on. So, and why that's happening is because interest rates, these long rates have come down, and credit spreads are still well behaved. Those are things that are embedded in our models, and they're still positive. So it's we're cautiously optimistic. That's of the past 12 expected soft landings, 4 of them actually have materialized. So based on that, we have a 1 in 3 chance of a soft landing. But we think, as Justin described the numbers, the GDP number, the money printing and government spending, it's going to give a bit of a push, at least in the U.S. here, and is going to, I think, move the odds probably 50-50, I don't know, or 60-40 in terms of a soft landing. So that's what's sort of driving the markets right now, our models, and the world. We're going to focus on the U.S. That's where the growth is, focusing on quality companies that actually are profitable and have earnings. Geopolitics could be a wild card this year. They were ongoing last year, and the market seemed to climb a wall of worry. There's a lot of things that can go bump the night next year, and we're watching those closely. So right now we're overweight equities, market weight in bonds, and underweight cash. Next chart, please. If you look at real yields, we brought this up last year. They are still elevated compared to where remember the new normal? That's when governments printed a lot of money and bought bonds, and so real yields went down. Bond markets weren't that attractive. Well, they're more attractive for the average investor, and that's a good thing if you're an investor. Not so good, as Sebastian said, if you're a government and have to pay these higher interest rates. So that's really an issue in terms of the debt that's out there. And I think that's why we're getting the higher real rates, because people are concerned about potential inflation longer term and government overspending and government debt. And so that is what's driving this here right now. So it's bonds are attractive still, but it's on the flip side of that, it's going to be put more pressure on governments to clean up their act. And I think, come next election, after the next election, 2025, and there's elections all over the world this year. I think next in 2025, the story will be how will governments cut back and solve some of their debt issues. So next chart, please. You look at profit margins, they are rebounding. Inflation has been coming down. We're still getting decent nominal growth. You look at the GDP numbers this morning, 3.2 real in the US, around 2.5 inflation. That's around almost 6%. That's pretty good growth for corporations and purchasing. So from a corporation perspective, wage costs are slowing down and growth is still there. So looks like we're going to get a bit of a rebound here in margins. The bottom-up analysts are forecasting around 8% in 2024 and about 12% in 2025, so about 10% over the next 2 years. They're always high. You probably can cut that number in half, but still it's a positive number as we speak. So something positive. And we think we're going to focus on companies I mentioned that are profitable, that have earnings. Next chart, please. As well, you can see with the stronger U.S. growth, we can see the earnings momentum is definitely in favor of the U.S. over the rest of the world. This has been this way for a long time. We went to actually negative last year for the first time in a long time, and then rebounded this year here again as the rest of the world, Europe and China, are slowing down. Next chart, please. Now, if you look at valuations around the world, the U.S. looks the most expensive. And what we do here is we simply look at the earnings yield for stocks minus the earnings yield, or minus the yield on bonds. Now, the earnings yields for stocks, what we do is we take the earnings divided by price, or the reverse of the price earnings ratio. So right now the PE is around 20 in the US. 1/20 is about 5% for stocks in the US. That's their yielding. Bonds are around 4%. 5 minus 4 is 1%. That's where you see the 1% differential in the chart. Now you look at Canada and Europe. They have better value. Some would say, well, they really haven't done much in terms of growth, where the U.S. has grown its earnings dramatically over the past 10 years, probably double what the rest of the world has. So they deserve a higher PE because they're stronger growth rate. But if you dig deeper and go look at the average company in the U.S., it isn't that bad. Next chart, please. And what we've done here is we've looked at the price earnings ratio of the S&P 500, which is based on stocks capitalization, versus the equal weighted S&P 500. And the index itself, the S&P 500, has a price earnings ratio of around 20 versus about 16 for the equal weighted S&P, or the average company in the US has a PE of around 16 times. Now, if you compare them to the long-term average, 16 for the average company versus its long-term average of around 15, that's not that bad. Versus the market itself is 20 versus long-term average of around 15 and a half. So bigger spread there. That just reflects the growth and the performance of the Magnificent Seven. So we think next year the performance is going to broaden out, and the average stock will do probably better than the Magnificent Seven. We don't think the Magnificent Seven are going to do that bad. They still can manage their profits. They're still growing. But we think they've had a great run last year, and the other 493 in the S&P 500 will probably do better in the course of next year. Next chart, please. So one of the big concerns, of course, is all the geopolitical activity going on around the world. It's also a big election year. I think there's around 60 elections this year around the world, so it's going to be a very interesting year. Number one thing, of course, the Ukrainian-Russian conflict. There could be an impact on oil supply, oil transportation. As well, there's talk of the West confiscating the Russian central bank assets around $300 billion. That could impact US treasuries and dollar volatility as investors move away from the US dollar. So we're not sure what's going to happen, and we'll have to wait and see. I think one of the things here too is in an election year, I think the administrations, in particular the Biden administration, do not want any major disruptions to energy supply. So that might mitigate some of these actions here. We'll see. And similarly, in the Middle East conflict, we're already seeing some issues there already. If they did close down, say, the Strait of Hormuz, you could see oil spike to 150. So that could have an impact on inflation and really be a crimp on consumption for consumers. That's something to keep an eye on. I think the real concern is the Taiwan-Chinese tension. If there was an embargo of some kind, or even an invasion, it would be very bad for number one, for semiconductors coming out of Taiwan, but also there probably would be just a whiplash, impact on some kind of issue or constraint on Chinese trade, which would affect all of us, of course. We get so many products come from China. So that's really impact our supply chains around the world. Looking at the US elections, we don't know what's going to happen yet. It also depends on who wins the House and the Senate. One thing we do believe is, as Justin's mentioned with the debt, whoever gets in, whether it's Democrat or Republican next go around in the US, you're going to have to deal with the debt problem. It's going to be much like, I think, the 1980s when Reagan and Thatcher came in and had to deal with that issue there. So it's going to be, I think, a different political tone come 2025. Next chart, please. So as I mentioned, our asset mix signals were positive on equity, neutral on bonds, and underweight cash. Within equities, we're favoring the S&P 500. Our emerging market signal started to go, this went positive last month. We're still concerned about that yet, given all the issues in China, but we want to see more confirmation of that. Within bonds, we're seeing corporate bonds still looking attractive versus government bonds. And within commodities, we're favoring gold. We see gold, signal's been stronger for some time. And usually in slowdowns, when the Fed eases, it does okay. So it could break out here. We'll just wait and see. So right now, that's our perspective. We're overweight equities, underweight cash, and neutral on bonds. Next chart, please. Now, looking at our asset mix across our global balanced fund, the policy weighting is 5% cash, left column, 5% cash, 45 fixed income, 65 equity, and 5 commodities. You can see how we transitioned through the course of the past 3 years. Right now, we're at 70% in equity, almost 24% in bonds, and 5% in commodities, being all in gold. And cash is minimal. Look at our dividend equity, its weighting is down to 15%. And our beta adjusted equity right now is 66.7, higher than our benchmark. And that is because our dividend strategy has a beta of 0.75 or market sensitivity of 0.75. And so that's why our effective risk adjusted beta is 66.7, just a bit above our benchmark. So right now, the Fed has pivoted. Our signals are positive. And I mentioned, but we're going in here with some caution. It could be a hard landing. It could be, odds are it's going to be a soft landing. It may be no landing. But I think it's more, the odds are favoring soft landing. But we are watching, we're on our toes. We have our signals, they'll help pick us up, I think help us get us right rotation. If we see a hard landing, we will be selling equity and buying government bonds most likely. So that's our perspective of where we are and our current stance. Next chart, please. So in closing, the Fed pivot is giving us some positivity in terms of our stocks and risk taking. We want to focus on the US in the coming year, investing in quality companies there as Europe and China stumble. We're watching the geopolitics, hoping for the best there, but we're ready to move if we have to. And we're sticking to overweight equities, market neutral and bonds, and underweight cash, and on our toes, cautiously optimistic on this year. And with that, we'll go back to the moderator.
Thanks so much, Wayne. Thank you. Excellent. So we have a few minutes for questions now. I'd like to invite, oh, she's already here. Look, she did it even before I asked. Mary Lou Miles, I'd like to introduce Mary Lou Miles, who's already sitting on the panel. As I mentioned, she's our head of wealth management. So she'll bring the portfolio management and more of the client perspective to your questions. So I've been looking at the Slido, and we have a lot of fantastic questions. We've got some really juicy topics to dig into. Now, it's 12:50, so for those of you on the live stream, we will keep the live stream going probably for 5 or 10 minutes after 1, just to get the majority of these questions, or as many as we can, answered. If you ask a question and it is not answered, I would highly recommend that if you're a Genus client, take that question to your portfolio manager and have that discussion with them. They'd be happy to answer that question or find out the answer for you. For those who are not yet clients of Genus, you can also connect with any of our team members very easily on our team page on the website. So if for some reason your question is not answered and we can't get to all the questions, that will give you an opportunity to have those questions answered. So I'm going to start with a live stream question, and then I'll go out into the audience here if you have any questions as well. So we'll start with... Actually, let's start with this one. This one I want to know the answer as well for. So this one is for Mike. The Securities Exchange Commission, the SEC, in the U.S. is finishing the approval of 10 exchange-traded funds in Bitcoin. Will we be including Bitcoin in client portfolios in 2024?
Thank you, and thank you for the question. I know Bitcoin is something that everyone wants to talk about. It's exciting. It's always volatile and kind of crazy. But so this is something that we most likely will not have in the portfolio in 2024. And so a reason for that is that Bitcoin is often seen as a hedge against inflation. People see it as something similar to gold. However, in this last inflationary period in 2021, 2022, it actually decreased dramatically in value. While gold was quite solid, even the S&P 500 was quite solid. So the whole thesis that Bitcoin is the new gold didn't really come through. But we are watching Bitcoin, and if we do find value there for our portfolios, it's something that we could do some heavy analysis on, do some back testing on, and possibly add eventually, but we don't have any plans to right now.
Okay, thank you. Could I get this one on, please? Encore team. Hello, hello. Oh, there we go. Excellent. Any questions in the audience here? If you'd just like to raise your hand if you have one, I can. Oh, okay. Yes, hi.
Hi, I was just curious why Genus is overweight corporate U.S. bonds and underweight U.S. government bonds. Thank you.
It's a valuation issue. So corporate bonds in the U.S. You have to be picky. Don't necessarily take on too much risk, but there is value. We see value in corporate U.S. Bonds. Again, keep in mind our perspective on the U.S. economy is actually a bit more favorable than Canada. So it's an opportunity, I think, to increase the yield of the portfolio. We still want to stay prudent because the corporate environment could change a lot, but we still see value in corporate bonds right now.
Great, thanks, Sebastian. All right, going back online, let's go to, it's hard to choose because they're all great. Let's go to Mike for this one as well. And this person apologizes for their question being very broad. That's totally fine. Broad questions are great as well. So not to worry. How have the returns been for the non-fossil free portfolio for the last few years, where there is exposure to oil and gas, coal, etc.? compared to the fossil-free portfolios, and any insight into 2024 and the future in that regard?
Okay, thank you for the question. So we have a lot of different funds, so it's hard to pinpoint what we're talking about here. But if we're talking about our CanGlobe fund, so our fossil-free CanGlobe, and then we have a regular CanGlobe, last year performance was quite similar among both of them. So the CanGlobe is part of the responsible funds, so it does have oil and gas, and then the fossil-free does not have oil and gas. And so their performance was quite similar. In terms of fixed income, if we are to compare our global impact bond fund to our global macro bond fund, they have similar-ish mandates, and their performance was quite similar as well.
Excellent, thank you. Anyone else in the room? Just raise your hand, or I will go back online. Okay, fantastic. So next, let's go to, there's a lot, so I'm just going back and forth one moment. Mary Lou, let's go to you. Sorry, I'm deciding which one. And I've lost the one that I want. My apologies. I know it's here. Okay, great. So regarding the Canadian household debt to disposable income, how do you feel about the disposable income figures? Do you feel like they're accurate, and are these figures understated from federal government agencies?
What a question for me. Jeez.
Throwing you the hard one.
Wow, I feel this is more a question for Justin.
Could be. Sure, you can hand it to him if you like.
But no, I'll try and dodge this. I mean, it's really like statistics, of course, are always difficult sometimes to analyze, and the things that we get. I mean, from our observation from clients speaking to us, obviously their disposable income feels less than it did 2 years ago. I mean, I think that's everybody feels that, from the inflation that's going, from interest rates, from food prices, from everything else. So I think it's just a matter of working with your portfolio manager, your client relationship manager, to see what your budget is, and whether if there's things you have to cut back, or whether, back to what Mike was talking about, are the values in your portfolio. What is it you're trying to achieve here? Like, do you want the last check to bounce, or do you want your kids to have an inheritance, or so all those conversations get mixed into that. So I think from, whatever it is from the statistical point of view for Canadians out there in the marketplace, I think it comes back to what you need to do for yourself.
Right, and what your experience, your lived experience is, yes. Okay, excellent. I have one for Wayne now, if we could please bring Wayne back up. Hi, Wayne.
Hi.
This is a doozy, are you ready? What are the implications for the markets if Donald Trump is reelected, including trade with Canada?
Wow, that's interesting. Well, last time he was elected, the markets went up. So, our thesis is that at the end of the day, in 2025, they're gonna have to deal with the debt. And I know he's talking, well, number one, he's gonna really push energy, drill baby drills, his mantra. He's gonna push that. Keystone may come back. That might be good for Alberta. We don't know. But I think he's gonna have to focus on the debt. And I think too that he's talked about rolling over the tax cuts. He may have an issue with that, I think, in terms of dealing with the deficit. Maybe the high end of the market, the high income folks may get hit. So I think too, from a Canada perspective, he needs friends. Like, there's so many tension going on around the world right now with China, with Russia, the Middle East. He needs friends, and Canada's a great friend, and he needs our resources and all the help he can get. So I think it's going to be shoulder to shoulder with Canada, going whoever gets in 2025.
Thank you. We'll stick with you for a moment, actually, Wayne. Sorry, can I bring him back?
Sure.
Thank you. Because this next question is about AI, so I think I'm going to throw it to you. And about Genus's use of AI, both on the investment side and sort of within the rest of the company. And then there was another piece of the question, which is, what do you think about AI investments for 2024 and 2025?
I think there still is momentum for just with the latter. There still is potential for the AI in 2024. There's just such a demand for AI. Now, there's different kinds of AI. There's the AI where companies like NVIDIA, where they're actually building the infrastructure. And then there's companies like Microsoft and Google that are selling software that's going to help folks with AI. So right now, it's like you think of the mining industry, NVIDIA selling the shovels and the picks to the miners and the store owners like Microsoft. So I think there's a lot of the momentum of selling the picks and shovels is going to go on this year. It's going to happen. And the question will be probably in 2025, what's going to be the uptake? Is the average business user out there going to actually use Microsoft and Google tools in their business? And to what extent? So that's going to be the issue. And but I think in terms of momentum, in terms of the picks and shovels, they're still going to be sold by NVIDIA and those kinds of manufacturers. In terms of Genus, where we're using it, right now we actually have it as part of our macro models. It's helping us select models. We're data scientists at Genus, so it really isn't a big leap for us to get into AI. And most of the hardest part is actually dealing with all the data and how you actually use that with an AI structure. And so we think it's going to help us, number one, with our productivity, helping us search for different factors, for different screens, a lot of things that were involved in a lot of manual attention in the past. We think we can actually pass off to AI, as well as help build better models. But I think that the biggest thing will be, I think the low-hanging fruit will be more in terms of helping improve our productivity and less manual intervention. So I think productivity boost is the number one thing.
Great, thank you so much. Mike, I'll give this next one to you, going to one of the topics that you discussed in your section, the climate value at risk. So the question is, will climate value at risk be used for all Genus funds?
Most likely not. Probably will just be focusing on fossil-free funds and impact funds. If we do find that there are great backtest results, great analysis showing that it dramatically increases performance in the past, or we believe it will in the future, then we would want to apply it to all funds. But right now, we're thinking of it probably as something for fossil-free and impact.
Okay, and you can keep that because I have another one for you. Any comments on the news in the last year around ESG funds shutting down? Why is this happening, and what is Genus doing differently?
Oh, interesting. So flows towards ESG funds have flattened out globally. In some areas, flows to ESG funds have gone down, especially in some areas in the States. Some funds have actually transitioned their names from being ESG blank or impact blank to now just calling it something else because they don't want to be associated with ESG or impact. This is mainly in certain states in the US. So a lot of flows are staying in ESG, but the labels on those funds are differently because they don't want the ramifications of that. At Genus, we have seen positive flows into ESG funds, especially into impact funds. So it's been different for us and different for Canada in general. Within Canada, Canada as a whole has been behind the curve when it comes to ESG and when it comes to impact. So we're still playing the catch-up game. Europe and the US has been a lot further ahead than us. So there's positive flows in Canada, especially for impact, but flatter most other places.
Thank you. Yeah, makes sense. Just seeing the sort of behind the scenes of why this is actually happening in terms of regulation and labeling is so fascinating. Sebastian, one for you around mortgage rates. So you mentioned mortgage rates. Given the Bank of Canada held that lending rate at 5% this week, and with a lot of Canadians having that fixed rate mortgage that's maturing. This is an easy one, I'm sure, to answer. Should clients stay in fixed term or should they opt for variable rate mortgages?
No, it's not that easy, actually. Ultimately, we get this question quite often, so it comes down to your flexibility. So if you have financial flexibility, given where we are in the cycle now, if we're right that the Canadian economy is slowing down, it's going to have to probably require lower overnight rates. Which would justify maybe going of more floating than fixed. That being said, it might not happen. So if you do have the flexibility, it might make sense. And the floating rate notes are still significantly higher than the fixed right now. So maybe not. I would wait a bit before I would do that. But there's going to be a point, I think, in 2024 which it might make sense to get out of the fixed into the floating.
Great, thank you very much. We're down to our last couple of questions now. We're a little bit over on time, so I want to be cognizant particularly of people on live stream as well as those in the room if you have other things to do with your day. So any other questions in the room, and then I'll go to the last question online. Okay, excellent. So let's tackle another interesting one. Mike, this will be for you again. At what point for sustainable investors will the Genus investment team revisit the screening out of nuclear with the rise in interest in small modular reactors to provide electricity?
Yeah, good question. So in 2024, that's definitely an area that we want to revisit. So we will be doing analysis on our side. We'll also be talking to clients because we want to do what is aligning with client values. So that's the most important thing that we're wanting to focus on. Right now, nuclear is screened out of the fossil-free funds and the impact funds, but it is in the responsible funds. As I said, there's been a lot of progress when it comes to nuclear. Nuclear is actually growing in terms of its overall capacity around the world, especially in China, India, and parts of Europe. So there are some big opportunities there. Of course, the world is looking for more energy security. So it's a big benefit there to have nuclear. Also net zero plans. So there are big opportunities. There's also big obstacles. Costs of building nuclear reactors have gone up. We've seen crazy prices in the UK right now for a reactor that they're trying to build. Also, uranium prices have tripled in the past 5-ish years. So prices are going up, but it is something that we will be looking into and revisiting.
Okay, so thank you all for coming today. We want to express our gratitude to all of you for joining us in person and those of you that are on the live stream. For those of you that are on the live stream, if you could just stick around for a few more seconds as we close, we're going to redirect you to a survey, and we would love to hear your feedback and thoughts on the session. For those of you in the room, you will be receiving the same survey via email, and again, we would love to hear your thoughts and feedback, please. I'd also like to just take a moment and acknowledge all of the people that it took to bring us all together here today for this event. So thank you to all of the Genus team who helped out with this, particularly Graham Farmer, who's in the back, who is instrumental in managing this project, and the Encore team, who's in the back right. You might have seen them. They're handling all of the live stream and AV needs for us. So thank you all so much for that. And a recording of today's session, as I mentioned, will be made available. So if you feel like you might have missed something, you want to go back to something, there will be that option, and you'll get it via email. Also, it will be on our website. So for those of you who are in the room, we have the room for a little while yet. The team will be sticking around. So if you'd like to stay, have some dessert, chat with the investment team, chat with the portfolio managers, we would love to talk to you and find out your thoughts and answer any other questions that you might have. So those of you on the live stream, again, thank you for being here and enjoy the rest of your day.